Hi, everyone. You should be able to see and hear me loud and clear. Let me know that indeed you can. And then we are absolutely ready to rock and roll and get on with it. You may well need a phone camera for this because there's some charts you'll want to take pictures of during the course of this webinar. And it's live, and I've got more slides than ever. You'll be pleased to know. I'm going to share my screen with you. I think I've got over 138 slides. That's how many I've got. 138 amazing things to show you. So let's get on with it. So the stock market update, unusually it's on a Thursday. Normally it's on a Wednesday. The reason is obviously the Easter weekend, and also well, I'm going to update you why in just a second. So yes, you can hear me loud and clear. It's fantastic. Let me know where you're from. I always ask that, and whether you're a first timer as well on one of my webinars. So where are we year to date? The S&P's already up 10% year to date. Year to date, up 10%, not bad. Now, if your pension matched that, well done, congratulations. Nasdaq's up 8.6. The Dow is up 5%. The UK market's as ever anemic and way behind what's happening in other parts of the world. Let's look at the past week. Where have the returns come from? And we'll pick on some of these companies later on. Some of the biggest performers haven't, for a change, been in technology. They've actually a little bit, we're getting into finance over here. I'm going to draw that for you. Some of the financials you can see over here, and some of the healthcare companies, and of course energy and industrials, which are often overlooked. And I'm going to come to industrials in a second. Over there, of course, we are in love with communications and technology over here because it has made us so much money. But we are also looking at plan B, which is how do we keep those returns we've been getting going. If technology sputters or splutters, then where else might the returns come from as well? Aidan, hello. Glasgow, of course. Barry, East Sussex, Nottinghamshire, Portugal. I bet you're having better weather than we are here. We have got a Rolls-Royce ticking all the boxes. I'll have a look. Good morning from Auckland. Fantastic. Well, Peter, it's wet here as well. So at least you're in New Zealand. Now, one thing I want to start off with, and we're going to go into individual stocks, is this. IFAs and the incompetence of diversification destroying pensions. So what I did is, this whole notion of IFAs and fund managers. So I picked these funds. Now, I wanted to pick a bunch of funds which had good name recognition, like Invesco, Schroders, Baillie Gifford, Scottish Mortgage, Aberdeen, BlackRock. All right. I wanted to pick ones which were global and US and European and UK. So I did that, right? So I took those. I wanted to pick ones which also were country specific. So you've got US, you've got China, you've got UK, and then you've got continental Europe in there. And also not just one sector like stocks, but you've got property. So I picked these. And this is typical of what you might see an IFA or a wealth manager pick for you. And they'll say, well, Alpesh, you know, this is good because it's diversified. Each of these funds are buying 20 to 30 to 40 stocks in my pension. And that's what they'll say to you, the IFAs. And they'll charge you the fees and they'll say, now go away, leave us alone. Don't call us for another year. Okay. So where are we with these? How do you think they perform? So I looked at these and I thought, well, yeah, that's a good list. Let's say your IFA or wealth manager, in the arguments of diversification, put these into your pension. Okay. That's what you got in 2022. Now, I'll address the issue of, well, maybe that's a bit unfair, just 1 year and a bad year in the market. But surely a bad year in the market is when you want them. That's what you want their expertise for. That's when they're supposed to pay their fees. In a good year, all boats rise. You don't bloody need an expert. Let's just look at 2022. Those were the returns. And you might say, whoa, Alpesh, that's a bit unfair. They wouldn't have just bought these. They might have left some cash. Let's hope so. Let's hope they kept you something which they didn't fiddle with and touch. Those were the returns. Hey, where's the diversification? Where's the, we pick US and Europe and British and China and all of these things just to protect you and give you, well, wait a minute. Okay, so you might say, well, that's really unfair, Alpesh, because you should look at the next year, because 2023 was phenomenal. It was one of the greatest years in the stock market since the Second World War. 2023, the NASDAQ went up 55%, the S&P went up 25%, so presumably, at least the US ones, if nothing else, should have lifted up the boat. The world's largest economy saw a 55% rise in its major index, okay? The world's largest economy, maybe it should have raised some boats, should have made it easier for these guys. I mean, to be fair, we should look at 2023. So I did. And some of them were amazing because they went down even in that year as well. I mean, that's a real skill, to lose money even when everybody's making it, right? Even when my grandmother's making it, right? And you might say, well, no, Alpesh, come on, be fair to the IFA and the wealth managers and your Scottish Mortgage and your St. James's Place. Look, some of these went up. Look, they went up a bit. I mean, okay, not as much as NASDAQ. Maybe they don't track the NASDAQ. You're being very unfair, Alpesh. You're being very fair. Well, let's look at the barely given US growth, of course. Well, that is tracking NASDAQ, and that was up 55. Did it make up for the previous year's losses? Oh, no. Okay, so it lost half your money. So 100 became 50, and then it went up 22. So it ended up, what's 22% of 50? It's an extra 10. So you went up to 60. So you're still down 40% in 2 years. And one of those was a bloody blowout year. Oh, well, it's been a bit unfair to them. Well, I don't care if and that's US growth. So I get all these people on social media saying to me, oh, it's so unfair. You only looked at one fund. Oh, you only looked at 1 year. Oh, you only looked at ones which don't track the US. Well, I'll look at the whole bloody shebang. And if you want to transfer your entire pension to these IFAs and just say, listen, I tell you what, mate, just keep all the money, not just the fees, keep everything, then feel free. But that's the world we live in. And why does that happen? And we're going to address this in this webinar. Well, this is Meta from 2016, and I've dealt with this before. 2016, market goes up. They say it's like snakes and ladders, okay? They say the market takes the stairs on the way up, i.e. it's very slow, and takes the elevator on the way down. In other words, crashes like hell. Okay, now, we had a simple mathematical rule to get at. As you'll know, as you watch this webinar, I don't use, what's Alpesh's crystal ball say? Because that's not a very good way of exiting. The reason we got out in January 2022, simple mathematical rule, because maths, people can't disagree on. They can disagree on narrative and story and how good your crystal ball is, but you can't disagree on if it falls X, sell Y. All right, they just can't. What about getting in? Oh, well, that's simple. I'll show you that as well. It was on our approved filtered list, checked all the boxes, and the momentum wasn't falling anymore. Simple as that, based upon this, right? Really easy, really simple. And there's 18 books I've written about the darn thing and 200 columns in the Financial Times. Okay, and you can download a free copy of this afterwards as well. Scottish, John bought Scottish Mortgage last, what was it, August. Well done if you bought them last August, because in 2023, they were up 23%. And had you bought them, so you've dodged quite a few bullets there, John. Let's hope you keep dodging those bullets. If I was that lucky, I'd be out in Ukraine, because I'd be the world's greatest bullet dodger. That's amazing that you might be one of the few in 2 years who've made any money with Scottish Mortgage. I noticed that out of the 24 months, you were not with them for the majority of that time. And that's probably the best way to make money with Scottish Mortgage Investment Trust, is actually just not to be with them for 75% of the time, which obviously makes sense. So that's what happened over here, the 250%. Did we know it was going to go up 250%? Nope. This is an extreme example to prove the point. Your IFA will sink you during these periods. They will sink you during those periods. They will be on a sinking boat and they'll drag you all the way down. Okay, and time again, and that's what worries me. The government invented SIPs and ISAs because they wanted you to do it yourself if you were capable, rather than giving it to fund managers to screw you over. Hi, Ian. Hi. Welcome. When the maxi fell, Will, I'll answer you. I don't think I saw the email earlier today. I'm pretty good as well. Oh, no, I saw that one. Well, you might be looking at you're probably not looking at the monthly because there we go. And I'll answer that later on as well. But I don't recall any such thing in July. Now, I'll answer your question in a second. So yesterday, very busy day. We got a new thing coming out with the Financial Times. I will tell you in due course. The whole day was spent filming in the studios. You will be told about that a little bit later on. So I'll update you on that later on. And also, if you're on the Great Investments Program, I've got a dinner at my old inn on April the 19th. If you signed up, with my compliments, it's black tie. Don't worry. It's not snobby or snooty at all. It looks it, doesn't it? But it's not. You'll be welcome and you'll feel at home, honestly. It just doesn't look that way, does it? As well. So that's where we are. Now, let me see. I'll get your question out of the way, Will. I think you said July, didn't you? Where's July? I can't see it below. So I think you're misinterpreting something. The MACD hasn't fallen below the signal line from what I can see over there during that period. Sorry. Okay, so that takes care of that email. Now, there's a lot of selling on tech, so I'm aware of that at the back of my mind. Also, the S&P 500 has headed for a 5-month win streak, and it doesn't often do that. So I am expecting some kind of pullback. So how do we keep our nerve, or how do we know when to exit? How do we know when to stay in as well? Okay. And I'll answer some of those questions. We've got ChatGPT, got Adobe. That'll be coming in a little bit later on. As well. Hypothetical growth of $1 invested in the S&P 500 between different administrations. Now, I don't know about you, because obviously there's an election. Are we better off with Democratic president or a Republican? I can't see a clear answer. I mean, it's just a nice little picture to show you on that. And obviously there'll be something decided this year either way. This is just more out of interest. It's really nothing beyond that. Average annual S&P 500 performance, if you've got a Republican president and a divided Congress, you get 13.7, or you get 13.6 if you get a Democratic president, divided Congress. The only thing that might happen is, and I haven't looked at it closely enough, you might end up with a Republican president and all of this. So yesterday at the Financial Times, I'm going to let you into a secret. I spoke to Martin Wolf. Now, Martin Wolf, brilliant chap, who writes a great column in the FT on economics. And I said, do you think Trump will win? And he said, I think he won't win a majority of the popular vote, but he'll get the Electoral College and therefore win the presidency, which was interesting, which might suggest we end up here, some kind of divided Congress as well. Republican president, Congress is divided, so you end up with 13.7%, which is the best possible outcome. It's probably what we want as well. Okay. Oh, those slimming drugs. Yeah, there seems to be a lot of, they could be the next crypto thing. There's a lot of positive news about them, isn't there? I'll come to that one as well. I tend not to look at news story narratives. I look at data. So rather than opinion and things which are open to interpretation like news stories, I look at raw data and actual numbers. Now, you could say, well, numbers are open to interpretation as well. Less so. You know, the profit of a company has gone through auditors and regulators, and even then could be obviously easily manipulated. But and I look for consistency in those numbers. So they might manipulate once, but if they're consistently manipulating, great. At least you've got consistency and the market's falling for it. So we'll come to that in a second. Now, where are we on this? This is valuations. And of course, valuations alone are not the only thing that move stock markets. If they were, none of us would have invested in all the tech stocks and made a killing in those last year. Because you would have said, oh, it's overvalued, don't want to go there. Well, that'd be a stupid thing to do, because then you're ignoring growth, you're ignoring cash flow, you're ignoring dividend yields, you're ignoring consistent momentum, which is another factor which affects stock price movements. You'd be ignoring alpha, the ability to outperform the market when the market's rising and outperform the market when the market's falling, which is what you want as well. So we don't just look at valuation, but just to let you know where the undervalued bits are. So a bit of an X-ray on the market. Telecoms, clearly, energy, and financial. So if all other things were equal and I had a choice between a telecoms company or an energy or a healthcare or a bank and, let's say, I don't know, farming, buildings, and something else, or real estate, then I may well go for the undervalued ones if all other things were equal. But we'll come on to that. These are some of the things we're going to talk about in this webinar, everything from the NASDAQ to Alphabet, Meta, and all the rest of it. So let's get into it. And like I said, very importantly for the process I use, I don't care about what the board of directors say. Like Warren Buffett, I don't care what the board of directors say because they'll always say how wonderful they are. Okay. What I care about is what's the numbers that are coming out of their P&L, their cash flow, and their balance sheets. I don't care what journalists think about the companies, and I don't care what analysts think, because again, as my books have shown, based on the research of three particular economists, Daniel Kahneman, who passed away yesterday, sadly, Eugene Fama, and Richard Thaler, all three of whom won the Nobel Prize in Economics, went on to win the Nobel Prize in Economics, because I was writing about them before they did, that what we want to do is start with a large collection of stocks, say 10,000, which is why I look at all of these which are eligible for my SIP or ISA. They could be European companies, American ones, London Stock Exchange ones, and then I want to tick the valuation box. Are they undervalued? In other words, the price relative to their profitability. Are they growing profits and sales? Okay. Another word for sales is revenue. And are they providing income? Now, most important is valuation. Half as important as that, according to the academic research, which I published in my FT column, so very familiar with, is growth. And half as important as that is dividend yields. Also important is momentum. We know that from the hedge fund industry. In other words, trends tend to persist, but they're not guaranteed to, but there's a sufficient edge that we want that rather than not have it. So I'm not looking for turnarounds. Sortino and Alpha also come from the hedge fund industry. Sortino is average return versus the risk or volatility of missing it to the downside. If we miss it to the upside, we're over the moon. That's why people who look at Sharpe ratios are living in the 1950s. World's moved on. And Alpha is market goes up, you go up more, market drops, you also go up more. So we cheat. We just get high alpha stocks. That way we're an alpha fund manager because we've got high alpha stocks. And you can be in a high alpha fund manager, get high alpha stocks. It's not that complicated, is it? I don't really care what sectors they're in because I'm bottom-up investing. I'm looking at companies, not sectors. Don't really care about that. And for those who think, yeah, but Alpesh, doesn't that mean you could be highly correlated to, you could have too much concentration in a particular sector? Well, if you do some correlation analysis, you'll see that when the markets fall, and again, there's been academic research on this, when markets fall, Costco and Microsoft both drop. In other words, a wholesaler and an AI company both drop at the same time. Okay, so there's increased correlation to the downside when you need diversification, and lack of correlation the most. You don't get it, which again puts a lie to this whole diversification stuff. The world's moved on from the 1950s when most IFAs purchased their textbooks to do their multiple choice exams to get the qualifications. So let's look at the ETFs. Now, I've kept promising each month that I'll do a little presentation on ETFs. You lucky people, today's the day. I've got the slides. So you can see which ones over the past month have been doing rather well. There's crypto, which is in the news, of course. I just get the impression more and more that everybody involved in crypto is just some kind of shady, corrupt gangster, whether on social media or elsewhere, sort of highly involved in the drugs trade, trafficking of people, or money laundering. And the rest are just people who'd happily gamble the same amount of money at Vegas. I might be wrong. Controversial opinion. But there you go. That's why I bought my mother-in-law some crypto a few years ago and told her to hold it for 10 years. I thought one way or another she might get arrested. Hasn't happened yet. So let's have a look at some of these. And you can see the individual sectors, markets, geographies over here. So which ones might look interesting if you're into exchange traded funds? And why might you be into exchange traded funds? Well, you might think, you know what, I don't want that numpty fund manager managing my money. I'll just have a passive index collection of stocks. Or you might want lower volatility, which sometimes, not always, comes with a basket of stocks. Not always. Okay, so let's look at some of the ones which caught my eye. I'm not recommending any of these, and I don't own any of these. Daily semiconductor, 3 times leverage. So you really are happy to blow your head off if you've got that, because you could go from 71 all the way down to 7. You lost 90% of your money in 1 year. That's what 3 times leverage means. Okay. And you might say, well, hang on, Alpesh. We went from 7 all the way up to 46. We pretty much got 7 times our money back within a year and a bit. Yeah, not my kind of risk. If you put a gun to my head and ask me to interpret it at the moment, looks like it might keep going higher and get from 46 to 71. But be mindful, these things are volatile. It's 3 times leverage. What does that mean? Well, it means if the underlying stocks in the portfolio go up $1, this goes up $3. And if they go down $1, this goes down $3. Not my kind of thing. You might say, no, I love playing Vegas. Look, $4, get it up to 71. Bitcoin's not the only place you can go to have that kind of crazy returns. Entirely up to you. Not really my kind of thing, 3 times leverage, because at my age, it's not good for the heart. But I'm showing you because it's what's out there. Spider series, this is home builders, S&P 500. So spiders are the S&P, Standard & Poor's. Home builders ETF, so a collection of home builders stocks. Now, my worry with this ETF is it's a bit overbought and could be on the way down. It's already had such great gains from 51 to 110. It's gone up 100%. You might say, well, you missed that. Well, I don't do ETFs generally, but I'm happy to talk about them. And I do collect the data on them and show this. But now I wouldn't get into that now. And similarly with home construction, which is obviously highly correlated to home builders, bit overbought. That's the monthly momentum, which is the only thing I'm going to look at for the moment on this, because it tends to correlate well enough. Leverage scares you, Will. You are right that it should scare you. And if it scares you, thank you, Will, for agreeing on crypto. I was a bit offensive to people who might hold crypto and made a fortune on it. But yeah. So that's that one. S&P, oil and gas exploration. Right. Well, now this is one of those, if in doubt, leave it out, because this could go up and it could do really well, or it could go down. If it doesn't make me sufficiently excited, then I'm staying out. Okay. So if in doubt, leave it out. Right. This is the S&P 500. Now, one of my students asked me about this, and he said he's got this. And I said, look, if you've got it, I just need you to keep an eye on it, because I need you to be comfortable with the fact you can go from 91 to, what is that, 65, 91 to 65. So you can lose 33% within a couple of months. Okay, are you comfortable with that? Obviously, you could stay out of most of this part, because you'll just make sure that should this be falling from an overbought level, you'll be out. Okay, now at the moment it's midway. It's done that before and should continue doing this. And look, best case, you would go from a 60 to 134. You get 100% return. That's the best case if this keeps going like this. That's your best case. Do I have 3 times leverage S&P? I'm not going to answer that, actually, because if I say yes, you guys are going to jump into it, which worries me, because leverage, I should not on a webinar be saying to people, yeah, I've got it, so you should get it. No, so I'm not going to answer that. Daily financial bull, 3x. Again, similar to the S&P, and the financials are undervalued. That'd be the thing, but leverage should scare you. And I'll tell you why it should scare you. That went from 142 to 47. So you lost 75% of your money in next to no time. 75%. Oh, look at this. Look at how quickly it can go from 110 to 15. So you pretty much lost 85% of your money in a month. Let me say that again, 85% of your money in a month in January 2020. Now, that's me trying to tell you, don't do it. Don't do it. And the way I look at whether something's overbought or not, this is the monthly momentum. These are weekly bars. This is monthly momentum. And essentially, look at this. Okay. If it's in this top half, that's probably suggests it's overbought. If it's up here, right? This is midway. This is oversold. It's like a journey. You're taking a boat. By the time it's here, you not quite missed the boat. By the time it's here, you've missed the boat. Okay, the rises have happened, and I'd want to stay clear. And we'll do more of that during the course of the webinar. Industrial sector. Remember, I said industrials didn't look too bad. Bit overbought. Great rally, 93 to 100. Yeah, great rally. But look at that. For years, it went sideways. So for me, if in doubt, leave it out. Mid caps, because people might say, well, I want to get away from technology. What could happen? Well, that could happen equally. It could just go nowhere for ages. I don't know with this one. But look, I mean, it's not one I own anyway. That's what you're hoping for, that it goes from 345 to 500, which is a 70% gain. Somebody do the maths for me, please, to see if my mental arithmetic was any good at all. That's what we're looking at. I'm not saying I'm recommending it. I'm not. I don't own it. So that's where the mid-cap ETF is. But I said I'd do a webinar just on these. Again, this is the same thing. It's mid-cap ETF. This is just going sideways. It's gold, and people often ask me about gold, and as you can see, it's going sideways. So yes, I agree it could go up there, but equally it could just keep going sideways. It's pretty flat. Not for me. Thank you very much. If it's not screaming out to me, take me, Alpesh now, then sorry, I'm not interested. So that's the way that one should go. You'd probably ease up, but then again, look at the volatility. Are you happy with 67? Always test what's the worst drops it's had in the recent, or drawdowns in the recent past, and are you comfortable with that? So that's 67 to 55, and you might say, yeah, I can handle that. I'm a big boy or big girl, I can handle that. Well, fine, then that's the thing. But just be mindful. Like I said, you can avoid that very easily. If it's overbought and the MACD starts falling, then get the hell out of there, in which case you'll be out right near the top. But that involves you watching the darn thing. Taiwan, for all those worried about the Chinese invasion, that's should be doing that. And that would, if that did do that, be 50% rise. I'm not saying it's going to. I've not analyzed it any more than what you've just seen on the screen. And my graphics team and data team put this together 5 minutes before the webinar. Okay, so it's not a considered opinion on that. It's just looking quickly at the momentum. Again, a bit overbought, so I'm going to stay away from that. Although lots of articles from Goldman Sachs about how Europe's the new. Who would have thought? The old world is the new world. So if it did do this, then you'd be looking at what it did before, which is, what's that in percentage terms? 47 to 51. That's hardly worth the effort, is it? So not for me. Gold, yeah, I think you've missed the boat on that. I mean, I know it's only halfway between this short and this short, between oversold and overbought, but I've prejudiced against gold. Silver, similar, can't see it. It's not screaming out, take me, take me, take me. So don't want it. Bitcoin, yeah, well, definitely missed the boat on that if you were looking at the ETFs, because it's all the way here. You might say, no, it's going to the moon. YOLO, which I think stands for you only live once. Well, some of them do. Right. iShares Bitcoin Trust. Right, let's go back to equities and what we look at. And just to calm you down a bit on some of this, and, to make sure the stock market isn't a get-rich-quick scheme, despite the fact that last year NASDAQ was up 55%. This is what JP Morgan thinks is going to happen. This is their forecast. They think, and obviously at some point they're going to relent. Somebody's going to get a slap in their research department from the CEO, and they're going to say, okay, we've revised upwards our year-end target. But at the moment, that's their year-end target. From 50, they think there's going to be a 25% drop. Sorry, a 20% drop in the market. That's what they're saying. Obviously, they're going to quietly revise that upwards because they're embarrassed about how rubbish they are at forecasting anything. The S&P 500 forecast from strategists is this. Sometimes leads the way, sometimes right. I mean, that's this line. Okay, I'm not interpreting anything from any of this. I don't care what the analysts think. S&P 500 return after 5 straight up months and greater than 20% gain, because that's what's happened. We've just had a 5-month upward move. What happened in the subsequent 12 months? Well, you lucky people, the S&P is up 14% after that. It tends to be rather good. That's not bad, is it? And 12 months later, since 1961, you are 100% of the time, doesn't mean history will repeat itself, nothing's guaranteed, 100% of the time you're up, and on average 14%. And we've just had 5 straight months of upward gains on the S&P. By the way, that's the data for the FTSE 100. A minority of you think that the FTSE will be higher by the end of the year. So that's where we are. Now that I've just shown you what I've just shown you, let me ask you about the US. Okay. Do these differ to leverage daily rebalancing ETPs? In technical terms, yes, but too technical to discuss here. In fact, you probably need a lawyer and an accountant to work out how they differ. But yeah, how can you tell from the charts it was so bought? I think I've answered that one. Right. So that's interesting data, isn't it? So how have we done so far this year? How's the market done? And what's been leading the way? Well, communications are up 12%, energy's up 12%, financials are up 12%, industrials are up 10%, and healthcare are the big leaders over there, although we've got some late movement from materials. And all the way down here is technology. So everybody who's been saying, oh, it's tech's making the moves. Well, actually, no, it's actually all these other sectors which have been doing better than tech. Now, I don't look at sectors, so I didn't bet on which of these sectors would do best. I bet on the individual companies, and I'll come into that in a second. So continuing onwards with that, what about factors? Well, momentum has been doing rather well. Dividends, and growth and value. Guess what we do? We look for stocks which are value, growth, yield or income, and momentum. So we're looking for this. See that down there? See that bit that I'm covering? Now, what does that mean for us? It means we necessarily end up in these. Or if they didn't win, whoever won, we'd necessarily end up in, because we ticked all the boxes. Now, you might think, well, that's a bloody obvious thing to do. Why doesn't everybody do that? Why do fund managers say they've got a value fund or a growth fund? Remember at the start, the ones who lost all your money? How come they do a growth one and a value one or this or that? Well, I don't know. Go ask them. I can't speak for the idiocy of other people. But to me, it's obvious. Why would you not tick all the boxes when you wake up at 3 a.m? Do you really want to say, oh, sweetheart, market's not doing well, but it's all right. I've left it to a guy who lost 53% last year. But it's all right because since August, he's up a bit. All right. Up to you. Or would you rather say, no, I've ticked all the boxes and I know what I've bought and I've actually checked it across. If I really like that fund manager so much, I've checked it with what he owns because he has to display it on his website anyway. So you really could reverse engineer what fund managers are bought. But I want to tick all those boxes. It's my pension and I've got higher standards than I'll give it to some random bloke who's fresh out of university a couple of years ago. You do know, I don't know if I've ever told you this. So my secretary, who worked for me for 2 years, her next job was as a fund manager. Literally left my firm and joined Newton Asset Management. And for 2 years, she was my secretary. I mean, I taught her a little bit about the markets and how easy it was because it took about an hour to teach her. And then she left and became a fund manager. Okay. I mean, so what I'm saying is it doesn't require that much expertise. I mean, sometimes people think it's like being a brain surgeon. It really isn't. Markets over the past year, NASDAQ's now up 43%. The S&P's up 32. The Dow's up 23. Even the UK has been dragged higher, which is a bit surprising. So 43% on the NASDAQ. Now, average inflation-adjusted returns for US large-cap equities per annum over 12 years, it's 10%. So I can't take credit for returns when, on average, I'm going to get 10.3% anyway out of the large caps that I own. There are some people who are insistent on buying smaller caps because they've heard, oh, small caps do better. Well, actually, no, small caps have been absolutely screwing you for a long period of time. So that's not the way to go. It's because they keep hearing these little sayings from different periods. I wrote a piece once in the Financial Times about 20 years ago, which is the old market saying is elephants don't dance. In other words, big companies don't have big moves. Well, as I wrote then, and has been the case this year, look at the bloody data, not the cliche, which is, and the article that I wrote was actually elephants can dance. Look at these big cap companies, right? So this is the part of the problem. People go, oh no, I want more risk. I want more return. I know, I'll go small cap because I heard a cliche somewhere. No, look at data. Look at the data, not the narrative and the stories and the cliches and what the journalists might have told you. Vicious circle for the UK. I'm afraid small caps are struggling globally, but London has good reason to fret about the fate of FTSE 250. So if you are looking at investing in just UK stocks in your SIPs and ISA, I really would say, as I said in 1999, first column in the Financial Times, selling all my UK holdings, buying only US ones, because you've got more stocks to pick from. Now, on top of that, which is good for your British pension, but now, on top of that, you've also got significant returns and you've got the double whammy of the UK markets getting screwed on just basically what this article was about was either companies aren't, the quality companies are getting taken over and made private or they're not listing. So all you're left with is increasingly rubbish companies. And that seems to be the case. Okay, so it's in a vicious death spiral, but there we are. Top S&P over the past month. This is just for interest. I don't think any of these I'm talking about. Oh, Micron comes up later. Micron's one of ours, as you'll know, because I've been talking about it all the time. And I'm glad to say, out of 500 companies, it's winning the premiership, and it's one of ours. The others aren't. The others aren't ours. Okay. And I don't think we talk about, Dollar Tree. Somebody asked me a question in a second. I think Tesla, which we got out of all the way in October last year, thankfully, because it fell since then. And that made us about 50%, I think, from January to October last year. I'll show it in a second. It was on Telegram. These are on Telegram each week anyway. FTSE 350, I don't have any of these, nothing to talk about there. And just out of interest, just showing you these. Well, these guys can't even get their own stock price to go up. If they can't even pick their own stock, they want to pick it for you instead. Seriously. S&P 500, I expect this And as you can see here, when it was at similar levels before, there's still quite a way to go. You might get a few weeks. This is a weekly chart. You might get a few weeks where it can drop. I think somebody asked me about, well, they asked me about July. Well, in July, it was going up. Now, with the monthly MACD, if it's oversold like this, whatever it's on, if it's going up, that's good. If it's sideways, amber alert. If it's falling, double amber alert. If it falls below its own moving average, then that's usually a point where I don't want to be owning it. Okay? Pretty much goes with anything. All right? That's it. Me simplifying that. Right? Thank you. Jack, I'll come back to yours a bit later on. And by the way, frequency of rolling 2-year S&P 500 returns since 1950, the average positive return is 32%. Average positive return is 32%, and that happens 88% of the time. Yeah, I know what you're thinking now. You're not that clever, are you, Alpesh? You're just actually playing the odds that you're just going to get a really good positive return because the average is high, and it happens very frequently. And you're picking undervalued companies which grow, have momentum, good, strong cash flows, which will come to Croaky in a second, and high sortinos, high average returns with low volatility to the downside, and high alpha. Well, you're just playing the odds, mate. And you're ignoring all the news and the noise. That's just not fair. No wonder you can't be rubbish. You know, I tried, but I just couldn't lose money the way the fund managers do. But it is going to be important to make sure we don't do this, that we do avoid the negative returns. Even though they only happen 11.5% of the time, it's going to be important. And I'm going to explain to you why that's incredibly important in a second. And it goes back to the Meta example. Because even if you avoid half of that, okay, half of that, half the time, it makes a massive difference mathematically to your returns. Massive difference. Okay, let's take the S&P. If you could just even avoid half this drop, half of it, not all of it, half of it, right, it would make a massive difference to your returns, because then over 2 years, you wouldn't have had a 0% return. You would have had closer to capturing more of that upside. And with Meta, it's even clearer. So we spend a lot of time and energy looking at what's our insurance policy, what's the fire alarm when the market goes down. And 5 years out of 7, it'll go up. 2 years out of 7, when it drops, we want to make sure the fact that we put our seatbelt on every single day and didn't need to use it for 5 years, but we did one day of 1 year, think, oh God, let's wait in cash. That's worth the effort. And it is. S&P FTSE 100 looks like it might be doing something it rarely does, which is sort of go up for a change. That is 7% above what it was in 1999, or 8%, something like that, since what it was in 1999. Enough said. NASDAQ, it's getting overbought. Look, the last time it was at those levels, it did that, and it had relatively little room to go, not much more in percentage terms to go. So we keep a close eye on it. It'll fizzle, but I'm not getting out yet. I don't prematurely kill the goose that lays the golden egg, thinking one day it's going to stop laying golden eggs. Let me kill it today. That doesn't make sense. I'm not a premature evacuator of indices. Now, Apple, as you know, I sold 50% of it because it had dropped below its moving average and got a bit worried. So buy, hold, or sell. Well, I continue holding the other half. I've not sold any more. Would I buy more at this level? No, I'd really want to wait for this to go back up. So, and it probably will. It probably will. It's, you know, it's taken a bit of a beat. I don't think it'll go to that level, but it might, in which case I'll pick up the other 50% I sold at that cheaper level and I'll be happy. So that's with Apple. The analysts think 15% to the upside if it goes from there to what the average analyst thinks, but the average analyst is high as a kite, okay? And the economic data, the academic research shows the average analyst is absolutely bloody clueless, and the ones who get it right are random. They're not consistent, so pretty much ignore the analysts. Alphabet, that's going to be for my private members club only. Microsoft, well, again, would I buy more? If you put a gun to my head, yeah, but I continue holding what I've got. Am I selling? No, but I know there's a bit less room. I mean, look, it does this, and so it could easily have 4 or 5 weeks of drops before it goes back up. But I'd hold my nerve until this went down like that. And it isn't at the moment, and it keeps making me money. Okay, since January 2023, it keeps making me money. So why would I kill it prematurely? I wouldn't. And look at this point here where I did get worried, if you remember, and I said, oh, what's happening? It's going sideways. And I said to all of you, well, it hasn't dropped enough, so I'll just keep hold of it. So, and I did as well. Mitesh, RCL, and CAH. Well, oh, okay. Sorry. Oh, you're talking amongst yourselves, which is perfectly fine. Please do. It's nice to know. Entertaining yourselves. Amazon, private members only. Let's look at Disney. Oh, now it started taking off at last. Took ages, didn't it? So Disney's been one of my, I think, was it special situation on the approved filtered list? I can't remember which. But yeah, that's what I expect of it. I'm happy holding it at the moment. I had a bit of an argument with my cousin, my sister, who said, no, don't get Disney, folks, get NVIDIA. And I said, well, we've had NVIDIA since last year, but Disney I've had this year, and it's been going rather well, and I don't mind it. You know, the MACD is rising, and it ticks a lot of our value growth income boxes. So we'll have to see. That's good that it's gone up a bit, because I need to beat her on the whole, you know, since this point, what's going to win over the next 12 months, NVIDIA or Disney, and hopefully I win that race. Have a look at YouTube on why your IFA should be locked up. NVIDIA is overbought. Now, you know what my rule is. Once we're in a stock, and we've been in this since January of 2023, not because I knew about AI, but just simply because it was on the approved filtered list, value, growth, income, cash flow. I didn't read any of the news flow. I looked at the accounts and the results on the Excel spreadsheet. I need, remember, everything to be green. And by the way, just so you know how picky we are, how cordon bleu, how Savile Row we are, and exclusive we are. See all of these? None of these 10,000 stocks has all these boxes tick green. So none of these would be eligible for my SIP or ISA. And imagine if you are doing this, these are all the ones which could trip you up. These are all the ones that could trip you up and could end up with 98% drops or nothing. Right? None of these are eligible. None of these. And look at how much they can fall from their high. So be warned with the markets. Your capital is at risk, but none of these are eligible for mine. Okay, and this is why fund managers mess up so often, because they look at all these numbers and they easily get confused. They're not the smartest cookies. You know, they've left a good paying secretarial job and now they're fund managers. And, you know, it's difficult, obviously, for them to get it right, because look at all of these which are not eligible. All right, time and time and time again. So anyway, with this, it was in the approved filtered list. Then I didn't know it was going to go up 250%. If I did, I would have gone to Ladbrokes and said, make me odds on it going up 250%. If I knew it was going to do that, I would have bought that and nothing else. If I knew it was going to do that, I would have bought 3 times leveraged ETFs on that. More, I would have done a spread bet with, what could I get on a spread bet? 100 to 1 leverage on NVIDIA. I don't know, whatever I could get on a spread bet. Okay. And would have made an absolute, you know, what is that? Our money has gone up from what, 130 to 900, bloody hell, whatever mental return that is. That's nuts. Okay, so that can't be right. Yeah, that is right. Jeez. So what happened? Well, it just kept giving. Now, you'll know from my weekly broadcast, I was worried here because I said, oh no, the MACD's overbought now because it was looking overbought compared to this. It might fall. But in actual fact, it was either rising or worse, just amber alert going sideways. Didn't even go down, didn't, let alone cross its own signal line. So the rule anyway, as you know, is if it drops 25% from the peak, definitely want 100% out. But I said, if it drops 10%, I'll make a decision whether I sell 50% of it or not based on my risk appetite. Simple as that. Will, you can get it on Yahoo Finance. Tesla, so that's what we got on Tesla, and I got out, and I still cover it on here just to show you that what happened afterwards. So afterwards, it kept going up, and I thought, oh, maybe we got up too soon. It doesn't matter. I wanted to show people, look, I could get out, and it went up. Well, then it dropped, and it continues. It isn't a special situation at the moment. We'll keep an eye on it for you because it's a popular company. The point of these weekly broadcasts is also just a bellwether of what's happening in the markets. Meta is for my Great Investments program only. NXP, I continue owning, should do that. Happy with it. Qualcomm, similar kind of story. And at last, it's sort of getting some of that. See, what happens when you pick a company is it might, over 12 months, do a hockey stick, go nowhere for ages, and then jump up. Okay, and at this stage, people get very antsy. They go, Alpesh, it's been 24 hours. I know I've got to hold it for 12 months, but it hasn't gone up. What should I do? Now, those people should really not be anywhere allowed near sharp objects or computers or stocks. But this can happen. What they want is it to do this, and they're going to lead a life of disappointment because only about 10, 20% of companies will ever just do that and nothing else. And of course, the other thing a company can do is that it's unlikely just to do this because then it wouldn't have hit our momentum requirements. But if it does do this, and if you think it's all random in the markets, well, that's a third probability, that's a third, and that's a third. And we've got a cutoff here, which is 25%. So there's only a third probability of that happening, and we can only lose 25 on that. So naturally, obviously, and the other one, it could just go sideways. Okay, so call it a quarter then. So there's a 25% probability, not even a third, a 25% probability of that happening, and there's a 25% cutoff point. So the worst case scenario is a quarter of a quarter, which, as you know, is a 16th. I don't know what that is in percentage terms. So there's a 16th probability your portfolio is going to get one of those. And there you go. So anyway, that's where we are. Or rather, you pick one of those. And if you've got 20 of those, then you can do the maths. There'll be a quarter of which might end up like that on a. But if the market's rising, and obviously 5 times out of 7 the market rises, then that's not going to be 25% of the time. It's going to be less because the market's rising. If there's tailwind, as you know, statistically, other things rise. If, of course, the market's falling, you might get more of those. But how do you avoid that? I just told you with the broader market. So again, I'm playing the data and the numbers and the statistics as well. On top of that, value, growth, income, cash flow, Sortino, and so on. Okay, Netflix I don't own, as you all know. We only started covering it after this big rise here as a bellwether just to talk about the markets, and it's done rather well. Why don't I own it? Well, I can't buy everything, but also because it's in the news, and I thought, people talk about Netflix. It's popular. People like it to discuss it with their kids. Would I buy it now? No, it's a bit overbought. It's probably going to get to about here before it probably does all of this again or something. It goes in cycles. Okay. PayPal is, well, again, just shows you don't rely just only on the MACD. Look what happened with PayPal. Just went sideways. Okay. Paresh likes it. I'd rather wait. But the idea is if it goes from 66 all the way up to where it was before, you're going to get a 5-fold return. But I would not buy that today, just so you know. Like I said, if you want to look at the videos on Scottish Investment Trust, for instance, why I rate it 1 out of 5, and I've got 1 million views on YouTube, then have a look. Oh, forget those two. Popular with hedge funds. I didn't buy this, which probably in hindsight I should have done. I thought I'd be big and bold and go up against the hedge funds and say, I know this is popular with hedge funds. It's not one for me. It's a bit overbought. And of course, what happened? I was wrong. It kept going up and up and up. Doesn't matter. The point is, everything in my portfolio isn't everything that only goes up. This is a case in point. I didn't buy this because I thought it was overbought being here. I would rather keep things out as long as I'm keeping out bad things. I'd rather keep out good things as well, as long as I'm keeping out bad things. So I still keep to that rule. And yeah, it just kept going higher and higher. But it's not one for me. I wouldn't buy it now because it's still overbought. But this is one that I own, and it was popular with hedge funds. I've written not for me, but I did get into it subsequently. And I think eventually it'll sort of do this over there. I mean, the banks seem to like it. JP Morgan, 19th of March, just said buy. And interesting. That doesn't bother me what the analysts think. Don't forget on TikTok, 320,000 followers now, going up 1,000 a day almost. And on YouTube, why your pension is performing poorly. I break down the data. Now, the thing is, as I said, Daniel Kahneman, the Nobel Prize winning economist who passed away yesterday, I would lecture on his material before he won the Nobel Prize in 2001 as a visiting fellow on behavioral economics at Oxford University at Corpus Christi College. And sadly, he passed away yesterday. It's that education that I'm using to talk about this. So I'm taking the academic research. It's not actually my views as such. I mean, I agree with it. But what I mean is it's not my... I'm taking the research out of what he did, applying it to this and Eugene Fama and Richard Taylor, and showing you why pension funds keep failing and why they keep messing up time and time again. Of course, they might have a good day. Somebody earlier found Scottish Mortgage had a good day, but as long as you stayed out of it 75% of the time, you might do well dodging that bullet. Follow me on LinkedIn as well. There's a lot of good stuff there. I'm going to answer some of your questions now. These are some of the problems which come up a lot, and they'll probably come up here. So let me answer some of your questions as well. You might need to ask me again because there's quite a few questions which come up. Just to remain into a sip, what would you suggest are good to buy as all shares you discuss? You said to hold and not to buy at the moment. I can't give you individual financial advice, Mark. Sorry. If in doubt, I put the money in. Oh, that's Middesh. How can you tell the charts if it's overbought? I think I've answered that one. Neil Watson, how do these average? Oh no, I think I answered that. I won't go higher. What I'll do. What's your opinion of Eli Lilly? A lot of people ask me about this slimming drug. I'm starting to get a little bit self-conscious that they keep asking me about I don't know if my wife sent you to ask me, Alpesh, have you looked at this slimming drug? Have you looked at this slimming drug? I'm getting suspicious of you guys. I know. I got a few pounds on. I need to get rid of it. Eli Lilly. Okay. And company. Eli Lilly and Company. So we had it in the past and then got out of it. Probably should have never mind. Probably should have definitely have got into it because we got 71% in the past and should have got back into it, but didn't. So missed that bit. Only because there's just so much to look at. You can't be in everything. And it's a bit overbought. So if you're in it, you'd hold it. And if it dropped 10%, you might want to decide then what to do. If you're not already in it, I wouldn't be buying it today because I'm a bit worried. Yes, it could be an Nvidia, but I'm a bit worried that it's overbought. Now, you might say, well, that doesn't matter, Alpesh. I want this. I appreciate what you're saying, that's overbought, but for strategic reasons, I want it. Well, that's fine. That's fine. I'm not saying it's a bad company. I'm just saying that's what's worrying me. James, Yahoo Finance, people have already mentioned. Adobe, let me put up Adobe, because somebody asked me about Adobe. Adobe fell off. Now, Adobe's supposed to be an AI company, but it really didn't hit some of the numbers. And it's sort of a bit flat. The MACD is falling. It's not one I'd buy at the moment, I'm afraid, because the MACD is falling. And I'm not sure if it ticks all the boxes at the moment. My April list, this updated for April, will be coming out on April the 1st. But because the markets are going to be closed for the weekend, obviously, we might get it ready before Monday. And similarly this, so if you're on the Great Investment Program, keep an eye out for this, which is then the further filtered curated list. So just for those who don't know, what I do is I update all of this. See all these tabs at the bottom, that all data gets updated. So you've got the transparency of the data, and then we filter it for you. And then my data team gives to the graphics guys the presentation do, and then I get a black pen and delete any of the ones I don't like. So then I manually basically curate it. So this is the Savile Row bit. That's the bespoke bit. This is the custom, pulling out all the data on 10,000 companies from various sources like the P&L and everything else. Any other questions? Can you discuss Dollar Tree? I can discuss Dollar Tree. Let's look at Dollar Tree. So that's Dollar Tree, which fell off a bit of more than a bit, 150 to 125. If you want to avoid, let's have a look. Let me just make it clearer. So that's the monthly MACD, and notice how it's oversold. It's not crossed its signal line. So let me tell you something really important. Okay, which oops, no, that's not what I wanted to do. I wanted to not do that. Let me see if I can. That is really annoying. Oh, I know. Wait a minute. Sorry. I'm going to put Dollar Tree back up. I'm going to teach you something which I think is incredibly important. Here it is. If you want to avoid, or you want to be less risk loving, so you want to be a bit more risk averse, then if the monthly MACD, I mean, you still got to tick all the other boxes on value, growth, income, cash flow, Sortina. But if the monthly MACD is flat, that's slightly higher risk. I mean, never have if it's falling, but if it's flat, slightly higher risk. If it's rising, slightly better. If it's crossed its own moving average, that's slightly less risk. Now, this had never crossed its own signal line, so that's higher risk, which I'm happy with. I don't mind higher risk, but you might not. And if you're asking the question, it means you don't like higher risk. Okay, so just so you know. So you'd probably want to wait for this to cross. But of course, the downside of that is when it crosses the moving average, it might have moved up a bit. And that's the trade-off. You can't have it both ways. You can't have free money, basically. So that's that. Rolls-Royce is exactly like NVIDIA. The same thing. If it drops 10%, then make a judgment. But I wouldn't buy it at these expensive places. Patrick, I'll tell you how you get the spreadsheet. And the weekly updates and unlimited access to me to teach you as well. Patrick's about to get really excited about all that. There you go. That's where you go. Thoughts on XLPE? I can't cover all of them. I covered a lot of ETFs. Sorry, I'll try and do that next week or something. That's all of that. And this is the IFA problem that we're trying to solve. Okay, people holding on too long, not getting the returns, and that's one of the reasons for doing this, to try and get you to be better equipped and teach you what to look for, how to do it. Whatever you do, however you do it, make sure you look at value, growth, income, cash flow, Sortino, alpha. Okay, those are the important things. If there's a market tailwind, you'll do better. If you've got high Sortino stocks and high alpha stocks, you'll do better. It's not me saying it. It's logic. They've got high average returns. There's no guarantee, but they've got high average returns, low volatility of missing it, and they tend to do better when the market does better, and they do better even when the market falls. Okay, and that's the rule we use. And you need to be able to go into cash, as I showed you with the MACD or the 25% rule. Use either. Simpler is the 25% rule. A little bit more complicated is the MACD rule. But you'll need those years to stay into cash. If you want to try and get good returns, you need to avoid the market when the market's falling. Is it worth doing? Well, you only need to monitor it once a fortnight. Good years will make up for the bad. Croaky stocks, that comes from Goldman Sachs Wealth Management. What they discovered is companies in the top quartile by cash return on capital invested generate 30% per annum as a basket. Okay, not guaranteed. Nothing's guaranteed. Even the sun won't rise tomorrow, potentially. So even that's not guaranteed. Hold for 12 months, then I reevaluate, sell anything which drops 25%, right? But sooner if I see the MACD. That's it. That's it. It's really that simple. And the reason for all of this is because I get emails like this from people who've got 20% growth in 10 years. They got next to bugger all. You know, over 10 years, some of them, let me know the returns your pension manager's getting you in your IFA. Feel free to shout out the bad ones. If you find a good one, I'd be shocked. So I won't even bother asking. And even an index could have given her that. This poor lady ended up from 100,000. She got 120,000. Whereas just even tracking indices, she could have done better. Thank you very much. Thank you. Thanks, Patrick. Thanks, Hype around Gavin around crypto. I'm really not the person to ask about crypto. Okay. I stay in my lane. I know my stuff. I stay in that. There's no point asking me. You might say, Alpesh, you seem like a reasonably well-informed, intelligent person, which is exactly why I'm saying to you, I'm not the right person to ask about crypto, because I'm a reasonably intelligent, well-informed person. I'm also self-aware. I put all that into value, growth, income, 12-month hold and repeat, 15 to 40 stocks, usually about 20 is what I have. And that approach works. How did we do last year? Well, last year was ridiculously good, which is why I like to crow about it. But I can't take credit for last year because it's off the back of companies that did well because the market went up 25%. I do tend to pick US, further filtered final, MACD rising. And well, how did we do? And last year was not typical because much of 2022, we had to hold cash. It was next to 0% in 2022, some return from some energy stocks, but let's just ignore that and call it 0 in 2022. So how did last year do? Well, last year made up for the year before because those were the ones and they came out. And somebody once said to me this, yeah, but if you didn't include the good ones, you wouldn't have done as well. So, yeah, you're absolutely right. I mean, some people should not be allowed near keyboards, but that was it. Okay, last year, I hope it happens every single year for me. Of course I do. I'll be the richest man in the world very soon, but it won't. Last year was an exception, maybe an aberration. Having said that, looks like this year might be like last year, but God willing. I just hope they keep inventing new stuff after. My bet is after AI, quantum computing, and then the year after, this is me dreaming, by the way, the year after that, we get another massive rally from nuclear fusion and free energy and no more climate change. Telling you, that's me dreaming. Okay, it's not going to happen. And we keep getting 80% years because every year they accelerate innovation in something, and everyone goes, oh, quantum computing. My God, this is going to solve all the world's problems. And then it's going to be that. And then they make these And then the final year, somehow they managed to remove all bullets everywhere and replace them with fuzzy clouds and remove children being killed. I don't see it happening anytime soon, but there we go. Wouldn't that be wonderful? So here we go. That was somebody, and we gave him a little sarcastic letter. Opening SIPs and ISA, if you don't know, you don't have to be Barclays. It could be Hargreaves Lansdown, AJ Bell, anybody. It's pretty much the same process. You go online, you fill in the forms, and it's as simple as that. Or you can transfer your old pensions. It's just online, and they guide you through it. The whole point of these companies is they want your money, so they guide you through it in really easy-to-use ways, whether it's a free trade, Barclays, Interactive Investor, HL, whoever you use. They're all a little bit expensive. This is all subject to various caveats, but I'm just sharing that. And buying a share is pretty easy. You click buy, pick the name online, you say £500, and you press a deal. That's it. Simple as that. Trading 212, yeah, no, that's fine. I've heard good things. I haven't got an account with them, but yeah, Trading 212. Can you create an Alpesh ETF? I know, Kishan. We have thought about it. We thought about, the biggest problem is, and it's the same thing we had in the hedge fund industry, is distribution, is just getting enough people that it makes it worth its while. Thank you, Vimal. Thank you, Steve. Is that Vimal, my friend from school? Thoughts on service now? But I got out of it because I need to exit some of the stuff. So sorry. Alistair Key, thank you. Oh, yes, eggs, golden eggs. Oh, I get your... The goose that lays the golden egg. I just didn't make the connection. Absolutely. Well, I wish you all a very wonderful and peaceful. This is Scottish Mortgage. Be careful of name recognition. Okay, they destroyed 50% of people's pensions. So just be careful. And just a quick recap. Those are the things that you want to look for: value, growth, income, cash flow, momentum. Try and tick those boxes. If you're not ticking those boxes, then I'm afraid you're leaving too much to chance. So I just want to warn you about that. Equally, don't trade your investments. It's your pension. What I tend to do is try and tick those boxes. 12 months, 25 to 40 stocks as well. Well, 15 to 25 stocks. God, I'm getting confused. Minimum 15 stocks to 40, and then a 25% stop loss rule and 12-month holding. So those are the numbers. I said you might want to take a picture, or 20 to 40 I've written there, but it's really 15 to 40 as well. And this is why after you get past this sweet spot, you're really not needing to do more. If over 20 years, over 10 years, you got a 20% per annum and you add 100K, that becomes $1 million over 10 years. Now, you're not going to get 20% per annum, even though the market generates you 10% a year, because some years, like last year, and the NASDAQ goes up 55%, you're going to go massively up, and then the next year it might be flat, and then up again, and then flat, and then this, and then that, and then this, and then whoops, and then that. But the idea is you eventually end up here, and each year you've cloned yourself by year 9, where just that alone is making 100K. So you're making the same amount as your initial investment after 10 years. So 100K into $1 million that's what it would look like. Is it worth the effort? I think so. For 5 minutes every 2 weeks, that's what's worth the effort. I think that's worth the effort. The sooner you plan, the easier it is. Okay. It's as simple as that. I've written about it in the books. You can download a free copy of the book from alpeshpatel.com/links. And it explains it in more detail, and also some of the Nobel Prize winning literature. But it really is easy to read as well. And it's free to download, alpeshpatel.com/links. I've also written all these books as well. But that's why I think you can be better than an overpaid fund manager like that, numpty. And that's me proving it. So I was at the Financial Times again yesterday recording, as I mentioned. 20 years later, we're recording 20 years since I won. I should do some kind of celebration. 20 years since I won that competition. I think I should do that this year. I do throw a party and invite you all somewhere in London. 20 years since winning the competition and how it was done. I think that's a good idea. Now that we're in the age of all the rest of it, and he got 9.2 billion. Obviously, what happened is when he came 14th and narrowly beat the cat, people meant to give me the 9.2 billion, but somehow the money got diverted to Neil Woodford. How did that work out for them? Am I bitter? Of course not. I'm not going to go into all of this. That's Warren Buffett's portfolio. That's Bill Gates'. This doesn't mean you buy into it. What it does mean is just look at how little money he has by the time he gets to its 8th largest holding. Same with him. You can concentrate your holdings. You put all your eggs in one basket, Easter, and watch the basket, which is what Warren Buffett says. If you've got the data and you've got the knowledge, those are two things. If you don't, then you might be better off with more of that kind of sort of structure. Okay, and that's the Goldman Sachs one. Goldman Sachs Asset Management, that's the Croakey cash return capital invested. That's from their research and development team, Goldman Sachs Research Quantum Database. 30% per annum is what companies in the top quartile generate. It's what they tell their richest clients. And I took the slides, and they're in the educational material on the Great Investments Program, and that's why I have to tick that box. I have to tick. It doesn't guarantee the stocks will go up. Doesn't guarantee it, because in some years like the financial crisis, nothing went up. But in other years, when it's good tailwind like last year, you get absolute bloody windfalls. And that's what you want. High cash return on capital. And if you think about it, it's pretty bloody obvious why. Companies which generate lots of cash and you only have to expend on investments once, license to print money is the phrase, isn't it? Don't worry about those things. Okay. This is a typical bad portfolio. So if yours looks anything like this with a whole bunch of bloody funds and companies which are going nowhere, it's because you've got too many holes in your portfolio. That's the problem. Okay. I will leave you with that. Thank you very much. For everyone who's already on the Great Investments Program, you'll get a more detailed one. That's my secretary. She became a fund manager straight after leaving my firm, worked for me for 2 years straight out of university. Her background's in English literature, part-time opera singer, and then went into fund management. And she's brilliant as a secretary. I'm assuming she's really good as a fund manager as well. So this is something that anybody can learn, is the point. I like Naomi, and I'm really glad. Actually, one of my other secretaries is now global head of marketing at Wells Fargo Bank, and a third secretary is now a lawyer, a pensions lawyer at Sackers. My point is, I want them, and actually, no, the fourth one wasn't a secretary. I want them to go off and do great things than be secretaries. And I'm proud I've been able to help them do that, because it's actually their talent. But being a man, I'm going to take credit for the hard work and talent and ingenuity of a woman, of course. So anyway, that's that. If been doing it for a long time, that's when I had hair. I'm going to get a hair transplant. You heard it here first, guys. But yeah, and we've had lots of great positive reviews. Thank you everybody who's joined up on the Great Investments Program as well. Thank you all. I'm going to leave you all now. If you've got any questions at all, just email me. Lost of my bonds doing, Alejandro, just remember you were going to talk about Micron. Oh, I thought Micron was on here. Do you know what? I think it's on the private client one. You're right. I will keep my word and I will talk about Micron. So Micron, for those who are already on my Great Investments Program, it's one of our ones from the approved filtered list. And Micron and Supermicrocomputer were both on our approved filtered list and part of the portfolio, and they've done better than I imagined. As you can see, Micron just escaped. And like NVIDIA, the strategy now really is, it's a momentum play now, is if it drops 10%, then I'll have a think. But at the moment, I continue holding, and I'm not going to kill the golden goose laying egg machine any soon. Thank you. Happy Easter to you all, and a peaceful Good Friday. These holidays sometimes people lose the religious significance behind them, and whatever your faith is, I hope, and it's religious time for Muslims as well, so I hope, and it was for Hindus holy this past week, and given with everything going on in the world, I hope you will have a peaceful, contemplative Easter, and be lovely and nice to everyone, and count your blessings, because if you're on this webinar, you are in the top 0.1%, not because of my webinar, but because you must be living in a nice, comfortable life to be able to have the time and energy to do this. So we are the fortunate ones. We have won the lottery of life already. Even though we're talking about making money, we have already won the lottery of life, my friends. So forgive me for a bit of a lecture at the end, but thank you all very much. I'm going to go to my family and annoy my son. He's 6. What else are you going to do with a 6-year-old? Thank you very much, everyone. And I will speak to you soon. Let me just turn that video off. Nope, that's not the one I wanted. It was this one. Thank you all. And once again, happy Easter. And God bless you all. If you don't believe in God, don't worry. He believes in you. See ya.